Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today, we'll talk with Marc Chaikin. Marc has been around the market since the 1960s. He's seen it all, and we'll talk with him about his power gauge system today. In the mailbag today, questions about silver, gold, stocks versus gold, the US dollar as a reserve currency, and a lot more. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, I want to talk about inflation, recession, or maybe both. That and more right now on the Stansberry Investor Hour. So this week, and actually in the past couple of weeks, I've gotten a lot of questions and just heard people asking others lots of questions about the idea that, are we in inflation? Are we in recession? Is it both? My wife is asking me what the heck stagflation is because she's not a finance person. And she's heard it discussed on television, as I have, and you probably have too. And what do these things mean? And more important, of course, what we're all about on this show is, what do you do about it? And I'm going to start with the what do you do about it, and then talk about what inflation and recession, or possibly both, a stagflationary environment might mean. But ultimately, the important thing is that I don't think it matters. If you're doing it right, if you're doing investing right, I don't think it matters. For example, do you think Warren Buffett sits around going, do I need to do something different this week than I was doing last week, or this month than I was doing last month because of inflation? I don't think he worries about that at all, because he's got this enormous portfolio that is loaded with well over 100 great businesses, many of them generating very high returns on the capital invested in them, and with really great advantages over the competition. And a lot of them, like insurance and his energy-related businesses, are probably going to wind up being very good inflation hedges. And I've talked about insurance as an inflation hedge before, right? Property gets insured, property values go up, insurance goes up, et cetera, et cetera. So he doesn't worry about that, because his strategy was always an all-weather strategy. And that is why I have constantly talked about what I call true diversification. And if you're saying, oh, here he goes again, I want you to know that I'm consciously doing it again. I'm consciously repeating this, because some things are worth repeating over and over again. They're really that important. And my idea of true diversification, as I've said before, is right now holding plenty of cash, holding stocks in really good businesses that generate high returns on capital and have good advantages over their competition, holding gold and silver, and probably some Bitcoin too. Bitcoin is an untried entity, but I still think it's worth holding. And that, to me, is a core, truly diversified portfolio. I think it will do well over the long term, whether we see inflation, recession, stagflation, war, hunger, famine, whatever horrible things happen in the world, as long as they're not too horrible, right? If we all get nuked tomorrow, it's not going to matter what your portfolio is. But through just about any kind of a economic calamity you can think of, I think holding this portfolio over the long term is going to do really well. And like I said, the point of this is you don't need to answer these questions about whether or not there's going to be inflation over the next couple of years, or recession over the next couple of years, or stagflation, which is basically, let's just talk about the difference. Inflation and recession are seen as opposites. Inflation is rising prices. Recession is falling prices. Inflation is a hot economy, right? Lots of economic activity. Recession is a downturn in economic activity. And sometimes you can get these things mixed together where you don't get the dramatic upturn in economic activity, but you do get rising prices. That's really hard on wage earners who are living hand to mouth, but investors can still do really well by holding assets and holding that diversified portfolio that I just mentioned. So that's the real point of my rant this week. You don't need, if you're doing the right thing, you don't need to change it. You don't need to change what you're doing if you're truly diversified, right? Investing is not about constantly making these tactical maneuvers week after week or month after month. If you're doing that, then, maybe you're the next George Soros or Stanley Druckenmiller or somebody, and you don't need my advice. If you're confident enough to do that kind of thing, you don't need my advice. But if you're not sure what to do and you're just saving for retirement, you don't want to get, obliterated by some economic trend, I think the truly diversified path is for you. And of course, everybody's different, right? I always say that too. Investing is personal. But the core idea that I think you can, tailor to your own personality is true diversification, cash, stocks, gold, silver, little Bitcoin. That's all I want to say about that. I think it's that important to repeat it every now and then, and I will be repeating it again probably sooner than you would ever believe. But that's all I have to say about that this week. Let's go ahead and talk with my old friend Marc Chaikin. Let's do it right now. Gold just passed $2,000 an ounce, setting the stage for a historic new bull run. Multiple billionaire investors are loading up on gold, including hedge fund founder Ray Dalio and real estate mogul Sam Zell, meaning now is the time to own gold. One precious metals expert is stepping forward with a big prediction. He believes we could see gold reach as high as $3,000 by the end of the year, possibly higher. Find out why and get instant access to his number one gold investment for 2022. It's not bullion, an ETF, or a mining stock. In the past, folks using this same gold strategy could have been able to make nearly 50 times their initial investment. Considering how quickly the price of gold has been moving, you don't want to waste any time missing out on the gains he believes are in store for this investment. To get a copy of his new free report with all the details, simply go to www.goldmania2022.com. Again, that's www.goldmania2022.com for a free copy of his new report. All right, it's time for our interview. This week's guest is Marc Chaikin. It's great to have Marc back on the show. After 40 years on Wall Street as a trader, stockbroker, analyst, and head of the options department for a major brokerage firm, Marc founded Chaikin Analytics, LLC, to deliver proven stock analytics to investors and traders based on the Chaikin Power Gauge. That's a 20-factor alpha model proven effective at identifying a stock's potential. Chaikin develops computerized stock selection models and technical indicators that have become industry standards, including Chaikin Money Flow, and pioneered the first real-time analytics workstation for portfolio managers and stock traders. Marc, it's good to see you again and great to have you back on the show.
Dan, it's good to be with you.
So, Marc, I was thinking about you recently, as I do sometimes, and I was curious about the indexes that you have created for Nasdaq. Every now and then I wind up on the Nasdaq website for some reason, and I come across, like this morning I came across Nasdaq Chaikin Power US Small Cap Index. And I was wondering, we've never talked about this stuff on the show. We always mention it, but could you tell me a little bit about how this came about?
In 2015, I got introduced to the index people at Nasdaq. They, just like Standard & Poor's and MSCI, Nasdaq creates indices that then used as the basis for exchange-traded funds. And Nasdaq, like the Power Gauge, wondered if we could take their three core indices, the Nasdaq Large Cap, which sort of mirrored the S&P 500, fewer stocks, the Small Cap Index, which was an alternative to the Russell 2000, and then their Dividend Achiever Index, which was the basis at that time for Vanguard's most successful income mutual fund. And what they asked me to do was to see if the Power Gauge overlaid on their pre-selected index components could improve the performance. And so we did a back test going all the way back to 2000, overlaying the Power Gauge rating, which, as you point out, is a 20-factor quantitative alpha generating model. And lo and behold, what we found was that just by eliminating the bearish and the neutral rated stocks within the NASDAQ indices, we could zero in on the stocks with the best potential. And the interesting thing is that these indices are rebalanced once a year on April 1st. So in essence, what we did was create a buy and hold portfolio using the Power Gauge as an overlay to the components that NASDAQ had put into their indices. And then demonstrated that the Power Gauge has predictive potential even on a buy and hold basis 12 months out. So the indices were launched. NASDAQ liked the research. They validated it in their own testing labs. And then subsequently, and this I can't talk about because it's an investable product and we're not registered with the SEC, a major insurance company licensed two of the indices and created two exchange-traded funds, the Nasdaq Chaikin Large Cap Fund and the Nasdaq Chaikin Small Cap Fund. And of course, this is not a recommendation to buy either of those, but those funds have been in existence since 2017 and have about $600 million in them.
Wow, I didn't even know about the existence of those. So I think it's really cool that you can basically turbocharge an index. I've never heard of this before. I think it's awesome.
And it works the other way. If you looked at Cathie Wood's ETF, the ARC Innovation Fund, as an index, and you overlaid the Power Gauge rating a year ago, you wouldn't have owned any of the stocks because none of them had a bullish rating. In fact, most of them had bearish ratings. And of course, we all know what happened there, where you're down over 60% from the high.
Right. Right. Of course, they launched, I think it was Tuttle created the SARK, the Short Arc Fund, within that time frame. I'm pretty sure it's less than a year old, but I could be wrong. But kind of a good time to do that, I guess.
I think it launched in October.
Oh, October? Okay, there you go.
It's obviously been a great time to short those stocks.
Yeah. How about that? And the Power Gauge, as you say, it goes both ways. Like it's completely subjective. It doesn't care, right? It's just a quantitative tool that sometimes it says short, sometimes it says long, sometimes it says what, avoid or neutral?
Neutral is not a bad thing. It just means, because we rank 3,000 stocks, basically using the Russell 3000 as the core universe, and then we overlay another 1,000 that aren't in the Russell, as opposed to a trend following model, which could be bullish on 90% of the market if you're in a strong uptrend. There are always 14% of that universe that have very bearish ratings, 14% bearish, and so forth. So everything's ranked on a relative basis, and that's really what investing to me is all about. You know, how is the typical money manager compensated? Compensated based on how he performs relative to a benchmark, which usually is the S&P 500. So it makes sense to me that you want to focus your portfolio, unless you're absolute contrarian with a huge appetite for drawdowns, on stocks that are outperforming the market or likely to outperform the market. And so that's what the Power Gauge is. Not a momentum model, but it incorporates a little bit of momentum in the ratings, but just a little. It's 85% fundamental and 15% technical.
Now, to me, that's the most interesting thing about the Power Gauge. And I probably said this before the last time you were on. I swear, if you told me everything about the Power Gauge except for that, if you said, well, you know, it timed the short on the ARC Innovation Fund brilliantly and so forth, and, you know, you can lay it over an index for 12 months and it'll outperform, I would have said, oh, okay, well, this is a momentum indicator. But in fact, and I'm just looking at the Power Gauge factors, which are available on ChaikinAnalytics.com. Anybody can go look at them. And it's, financials, things like price to book, return on equity, debt to equity, earnings, involving earnings growth, earnings surprise, projected PE, et cetera. And what a category called experts. So this is like short interest, insider activity, earning estimate trends, and so forth. And that is the thing that shocks me the most, because anybody, Mark, like anybody will say, well, fundamentals are great and valuation is great and, earnings trends are great, but, you don't necessarily want to use them as timing tools. But that's mostly what this rather brilliant timing tool is made of. Am I just wrong in thinking that? Like, am I wrong about this? Is that all there is to it? Thinking that fundamentals are bad timing tools is what I'm saying?
Well, I wouldn't call these timing tools. I think you can develop a methodology for investing your money that incorporates timing into it. I think timeliness more than timing is what the Power Gauge is all about.
Okay, fair enough.
And,
yeah.
And none of this is easy. As Charlie Munger, Warren Buffett's longtime partner, said, if investing was easy, we'd all be rich.
Right.
And investing is definitely not easy.
He also said, if you think it's easy, you're stupid. Charlie said that.
I didn't want to go there. I've used that. I don't want to insult our audience. So because some people do think investing is easy, and hopefully for them it is. But there are three factors, ironically, that you didn't mention that I want to zero in on. The first two are in the financial category. They're price to sales ratio, how much you're paying for a dollar of revenue, and free cash flow. And interestingly, those are Warren Buffett's two go-to metrics, and they're the most heavily weighted in that component, which is also the most heavily weighted in the model. So I call that the sort of foundation. And it's looking at some value metrics and then some balance sheet items like debt to equity. But if you pay too much for a dollar of revenue, eventually the market catches up to you, which is what happened to the hyped up, overinflated growth stocks. And then free cash flow to me is de rigueur, because you can doctor anything up with accounting techniques, but you can't mess with free cash flow. It is what it is. And then the third factor I want to point out is in the expert category, industry group relative strength. It's the most critical data point for investors, and that's what our big event last night was all about. 50% of a stock's performance can be attributed to the industry group that it's in. And when you think about it, that's really a macro indicator, because when industry group trends start to gain traction, like energy is right now, like the mining stocks are, it's usually because of big macro factors. You can get an individual stock that responds to an earnings report or a news story or a new product, new drug. Lululemon had some very positive things to say about their newly launched sneaker line when they reported earnings yesterday. But industry trends are what I call macro trends. They're big picture reflections of what's going on in the economy, and they also help you see, when you look at the charts, where the money is flowing. Is the money flowing into industry group or sector ETFs? And that's an indication that big fund managers, big investors have bought into the macro story.
That is really cool that you've got this macro indicator baked into this, and that it's 50% of the return. Wow.
Yeah, and by the way, I've zeroed in through an introduction that was made to me when I first got registered as a stockbroker in 1966. And please don't do the math. I got introduced to a guy named George Chestnut, and we talked about him on our webinar events. George Chestnut ran a mutual fund called American Investors out of Greenwich, Connecticut, and he published a newsletter that looked at industry groups. He did most of these computations by hand, because we're talking the mid-50s when he started this. And his mantra was find the strongest stocks in the strongest industry groups. And that's what he populated his mutual fund with. And I subscribed to the service after meeting him once. And when my sons were born in the late 60s, I actually invested for them in his mutual fund, which over a 10-year period was up over 300%. So George Chestnut was really a major influence on me. And to this day, I'm a firm believer that if you know which sectors and groups to avoid and which industry groups to overweight in your portfolio, you're going to outperform the market and actually sleep better because you're not indulging in what I call the most expensive sport in America, which is bottom fishing. It's a formula that's worked for me for the 50 plus years I've been in the business, and I think it's going to work ad infinitum. I really do. I think it's the key to making money.
Mark, you mentioned energy, mining. I saw within the past day or two here, one of the folks I watch who puts out a really good service actually that's all about sentiment indicators. He's saying that he's back in risk on mode. His risk on, risk off indicator is back in risk on mode. And I know a couple other guys, at least one other guy that I can think of who's got a risk on, risk off, and they're getting back in risk on. I wonder if you are in that mode as well, looking at like tech stocks, for example, which have gotten really treated badly this year. We mentioned ARK. Is it time to buy those again, do you think, or no?
No, actually, I don't think so. And tech is broadly defined these days. So a company like Chewy, which is basically an online retailer of pet products, as you probably know, in my mind falls into tech because it's digital retailing. But I think there's still a wide gap between valuations and reality in these tech stocks, particularly the ones with no free cash flow and no earnings, and they're all over the place. I do think it's time to take a look at some of the more beaten down, cash flow machines like Alphabet, like Microsoft, like Apple. But I think that we're still going to see major downside over time in the beaten down tech stocks that are just sitting there with nothing. Just give you one example. Fiverr, which enables independent contractors to find work online, is still not earning any money. Now, if you can't earn money after a 2-year lockdown when everybody was looking for talent, when are you going to earn money? Same thing with a company called Teladoc. At the Stansberry conference, that was my number one short, and Teladoc is down over 60% since then. Teladoc has been around for 20 years. They've never made a penny. During the lockdown, the stock skyrocketed, and then the power gauge turned bearish, and they're still not making any money. So I think you have to define what you mean by tech. If you mean cash flow cows like Adobe and Alphabet, and by the way, Adobe had a disappointing quarter, so not really a buy just yet, in my view, until shake out some of the weak holders, as we used to say on Wall Street. You have to differentiate between the cash cow tech stocks with, and here's a really important point, with pricing power. Because we are in a deep hole in terms of inflation, and I don't see that going away anytime soon. So why are the energy and the mining stocks going up? That's sort of obvious, but some of these big cap tech stocks like Microsoft and Apple have pricing power, meaning that they can either raise prices or maintain prices and profit margins won't suffer, as opposed to some of the manufacturing companies where they have to pass on the price increases. So I think there are some real opportunities, but there's still some landmines in the market. I call them rolling crashes, by the way.
Rolling crashes, I've seen that term recently in there was a Stansberry Digest about this idea recently. And I didn't use the term rolling crashes, but we've seen this since I want to say February, March of 2021, last year. So just over the past year, it seems like all the really crazy stuff, including ARK, peaked around February and March, and cannabis and clean energy and just all the crazy risk on stuff, even SPACs. And since then, it's been a series of just of, as you put it brilliantly, rolling crashes. Love that term. So let me ask you this, Mark, is there a rolling crash you think that lies ahead of us? What's the next crash?
Well, 60% of this industry groups that we monitor 21 industry groups that have power gauge ratings, by the way. We've combined fundamentals with technicals. The power gauge rating for the individual components represents the fundamental view, and then the actual price action of the ETF, the industry group ETF, is factored in. So there we are combining fundamentals with technicals in a big way. 60% have experienced these rolling crashes, including energy, starting from the peak that you identified for tech. Energy dropped over 20, the energy ETFs dropped over 20% from that January, February peak in 2021. And then the power gauge turned bullish in October of 2021, about 6 months ahead of this major spike up in oil prices and in energy stocks. So I think there are going to be rolling crashes. I think retail is pretty vulnerable based on what inflation is going to do to the consumer's pocket. And so I think there's some weakness ahead in retail, but 40% of the stocks haven't had a rolling crash of the industry groups. And I think there are going to be some of those that roll over as we go into, what is going to be a very difficult time for the economy based on where interest rates are going and where inflation is.
The power gauge is interesting to me in a number of ways. I already said one of them, which is it's mostly fundamental factors. And I was just thinking, it's interesting to me that this system could have worked anytime in the past decade, given the fact that, and you still hear this today, that people just seem to not care about fundamentals so terribly much, or at least until the maybe the last several months, maybe. But for a long, long time, fundamentals, as you say, many of these companies, they don't earn any money. They haven't made money. Teladoc hasn't made money in 20 years. But at some point, people are just get used to stocks going up so much that they don't seem to care about that anymore. And then they start saying, well, it's a new era. It doesn't matter. High growth. You don't need profits. All this stuff that we hear every 10 or 20 years. And yet you have a system based on fundamentals that works anyway. How is that?
Well, first of all, the sort of syndrome you just detailed, we used to call the greater fool theory. You'd buy a stock under the assumption you could sell it to a greater fool at a higher price.
Yeah.
The reason that fundamentals work in the power gauge is because we're not just looking at conventional fundamentals. So we look at earnings surprise. That's a fundamental factor. How does a company do when they report earnings relative to Wall Street expectations? If they outperform, that starts a virtuous circle of analysts upgrading their opinions and raising their earnings estimates. And I noted that 40 years ago. And then when I was at Drexel Burnham in the mid 80s, I was able to use their quantitative database to validate that. And the guy who ran that database, George Douglas, actually did the original research on earnings surprise and earnings estimate revisions and how they are big short-term drivers of stock price movements. And those are 2 of the 20 factors in the model. We also look, as you pointed out, at insider transactions, which are particularly valuable in small cap stocks, because if in a small cap stock, typically management owns a bigger percentage than they do in a large cap name. And when they take out their checkbook and buy their own stock, they can't trade that stock unless they want to run afoul of the SEC. So they're making a long-term bet on the strength of their business. And nobody better in small cap stocks to follow than insiders who are buying their own stock. We also look at short selling. I consider that a fundamental indicator, because shorts do good research. And you've been on the short side in your career, and you do really good research. And you have to, as a short seller, to survive in an irrational market, particularly. Sure. So I think if you just looked at price to book and PE ratio, which we don't look at, we look at projected P ratio and PEG ratio, price to growth, that might not work as well in the current market environment. But when you put together this stew of 20 factors, many of which are not in fundamental or quantitative models, then you really get something that's robust. And I call them all-weather factors. They work in stormy weather and sunny times, and we're very pleased. We've been public with this for 10 years. We launched in January of 2011. So not only did we have the back-tested results all the way back into the late 1990s, but we've had 10 years of real-time performance of the power gauge in, as you point out, some pretty unusual times.
Yeah, and I think it's cool. I don't know. I just really think it's cool that you were mentioning, you mentioned price to sales and free cash flow. And as fundamental factors go, they are really super important. For me, I look at price to sales over in all kinds of situations for individual stocks and industry groups and the entire market. But price to sales is kind of the no BS, right? It's the top line. It's before all the nonsense has come in on the income statement. And then free cash flow is at the other end, where you've backed out all the non-cash stuff, right?
Yep, I hadn't thought of it that way. I like that way to look at it. In the short term, price to sales, can put you on the wrong side of a stock. But over the long term, if you pay, I know there's a dividing line I've done in my back testing, and every industry group, by the way, is different, as you know. So banks and price to sales is not quite as meaningful. But in industrial stocks and software and so forth, it really does make a difference. You pay more than 7 times revenue, you're going to get a hurt put on you, as they say on the street.
Eventually,
hurt on me so bad. Yeah, eventually. But that's where momentum comes in. You don't want to be on the wrong side of momentum if you're thinking about going short. But certainly avoiding those stocks keeps you out of the kind of pain that people have experienced. I mean, take Peloton, perfect example.
Yes.
Peloton, a very, very high-priced exercise bike with a subscription bolted onto it that most people didn't realize doesn't go away, otherwise the bike doesn't work. And then suddenly reality set in. But if you look at the price to sales ratio on Peloton right now, I think you'll see it's still not something that you'd be comfortable with. And I'm going to give you another stock that I think could be the next Peloton. So Peloton right now has I'm just looking at the price to sales here because I don't have this one. Peloton is trading at 136 times revenue. And that...
Still, wow.
No, I've got the wrong symbol in there. Sorry.
Okay. I was going to say.
We don't want to go on record with that one.
Okay.
Let me just see. It's not that egregious. Sorry. It's still trading at 2.2 times revenue. And that's a problem.
That is a problem.
It's a problem for a stock that's not making any money.
Right.
And it's down, 80%. So here's the next one, I think. DoorDash.
Oh, DoorDash, yeah.
DoorDash. It's a company that should be making money. The whole takeout industry blossomed during the lockdown. But if you look at DoorDash and you look at price to sales, you're not going to be in a good place. You're at 8.3 times revenue. And here again, the company makes 34 cents a share and it's trading at 120. So no matter how you look at it, this is a stock that has downside written all over it to me. Can it rally 10 or 20%? Well, yeah, it just did. Just did off the March bottom. But these are the kinds of stocks that you have to avoid, in my view. I used to say when I get pitched a stock when I was on Wall Street by another broker or analyst, I'd say, let someone else make money in that stock. I'll pass. If they make it, they deserve it.
That's right. Yeah. And they better know when to sell. So, Mark, last week you did a really interesting event that was free of charge to anybody who wants to go check it out. And they can check it out at 2022marketwarning.com. And I wonder if you could just give us a flavor of it and tell us, basically what you did during that event.
We've actually touched on some of it already, Dan. Basically, I laid out the case for rolling crashes or rolling corrections, and the idea that the market is not the S&P 500 index. You have to drill down on a more granular level to sectors, but more preferred industry groups, because that's where you pick up these macro trends. So we highlighted how industry group strength is so important in doing your stock picking, because it does represent 50% of the stock's price movement, which can be attributed to the industry group. And we also laid out the case that it's not just the power gauge, but the power gauge is part of our industry group ratings. And the power gauge is great for determining if you've got a stock in your portfolio that might be vulnerable, like a DoorDash or a Peloton, or attractive, like almost any name in the energy complex right now. But that once you take it up a notch to the industry group level, you can really supercharge your portfolio. And the second thing we highlighted was the fact that there's a major buying opportunity coming in the market. And it's based on the research I've done surrounding the presidential cycle, the 4-year presidential cycle, and the idea that in the midterm election year, which we're in right now, the market makes a low and then rallies 30 to 50%. And we took the research all the way back to 1914 and determined that in almost every year, interestingly, the midterm in 20 out of 27 of those instances was either in a bear market or coming out of a bear market. And I would suggest that we've been in a bear market if you look at things from the industry group level. If you look at things in terms of the S&P 500, which is what most people do, you've had a correction. But in 20 of 27 of those midterm election years, you were in a bear market or had just come out of one, and then you rallied. In the other 7, you rallied. So it's like 25 out of 27 times you had a major upswing to some point in the following year, which would be 2023. So I think there's big opportunities coming, but I also think it's important to be in the right industry groups to take advantage of that broader swing in the market.
Wow, I am really curious. I'm going to be watching you, man, for when you're telling me that the time is right to anticipate that rally. But it sounds like you're not there yet, though.
We might have made a low in March at the 4,100 level on the S&P. We're certainly seeing some real strength coming into the market now, but my sense is whether we go to a lower low or whether we just test that low, that the low could come sometime in the fall, which is very typical, as you know, for the market to make a bottom in the September-October timeframe work. But if you were thinking that, okay, the bottom's going to be in October, you'd miss this whole move in energy and in the mining stocks and the chemical stocks, the food stocks. So that's why industry strength is so important. I think we do ourselves a disservice as investors to talk about the market. I know Warren Buffett likes to talk about Mr. Market, but Mr. Market is schizophrenic. If you will. He's going in a lot of different directions at one time.
All right, so just for our listeners again, if you want to take a look at last week's event, it's a replay of a really great webinar where Mark talks about the rolling crashes and some other topics. 2022marketwarning.com. 2022marketwarning.com. You should check it out. Mark, we actually have been talking for a little while now. Time flies with you and I. And so I wonder if I could throw my traditional last question, which is the same for every guest, at you and see what you come up with. And the answer should be something besides going to 2022marketwarning.com. And the question is, if you could leave our listeners with just one thought today, what might that be?
Ignore the headlines, do your homework, have a game plan, and make sure you know the right industries to invest in.
Boom. Sounds so simple. There's a lot of work baked in there, but it's simple and powerful. Thank you for that. All right, Mark. Well, always a pleasure to talk with you. I'm sure and I hope we'll do it again soon. You'll have to come back and as soon as you're ready to tell me that bottom is in, maybe we should have you back just so you can talk about that.
That's a deal.
Okay.
It's always great being on the show with you, Dan, because you have so much knowledge and you sort of lay it out in a very laid back way. Love being with you.
Oh, thanks. You hear that, everybody? That was the one and only Marc Chaikin. I mean, it wasn't just anybody saying that. So, all right, it's obviously become a mutual admiration society. That's probably time to say goodbye. So,
yeah, exactly.
All right. Good to talk to you, Mark.
And you, Dan. Be well.
All right. Bye-bye. Well, when two oldish guys get together and start talking about things, you can learn a thing or two, I think, especially from Mark. I won't even say from me, but from Mark for sure. I mean, he's been around a long time. He's been there, done that, seen it all. And he's created this system that is, as he put it, really robust, loaded with fundamental factors, which of course I love. I'm a fundamental investor. But there's also some momentum in there. So it's a pretty decent way to pick timely stocks, not just something that you might expect to do well over the long term, which is more my bag. And you should check the webinar out. The idea of the rolling crash is something that you should know about, because as Mark laid out, you don't just want to pay attention to the big indexes, Nasdaq, S&P 500, Russell 2000, they're good as far as they go, but they only go so far. And Mark's work into industries can give you a real advantage. I mean, great traders, some of the all-time greatest traders do this. Stanley Druckenmiller, I know, pays attention to which industries are strong and which ones are weak. So it's a really powerful thing that if you don't know about it, you should study it. And Mark's tools are a great way to do that. So go to 2022marketwarning.com. Check out the webinar. All right, time to take a look at the mailbag. Let's do it right now. One of the biggest fears I'm seeing right now from readers and podcast listeners is that there is no money left to be made in the U.S. stock market, that the extraordinary gains of the past decade are gone for good, and that anyone over the age of 50 who's depending on stocks for their dream retirement is out of luck, destined for pain ahead. Look, I'm about as bearish as they come right now, you know that. But with the right information and recommendations, it simply does not have to be that way for you. This week, you have a very rare opportunity to get a free stock recommendation from one of the greatest investors of the past century, Marc Chaikin. When Mark issues a big new prediction or a free stock recommendation, it pays to listen. He says that while things are about to get much worse for many stocks in the market right now, and I agree with him, you also have an extraordinary chance to double your money from here on a very specific group of stocks that have barely even faltered during the recent volatility. No matter what's happening in the broader market, I always pound the table on the unique stocks that can protect and even grow your wealth in times of trouble. They're rare, but they're out there. And that is exactly the kind of stock my friend Marc Chaikin just gave away. This is a simple, free way to put a little money to work for your future. So don't delay. Head to 2022marketwarning.com and get your free stock recommendation from Mark. Again, you can access everything at 2022marketwarning.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Well, last week we had a light mailbag and I told you about it and you responded and you fixed it. So I appreciate it. All right, let's dive in with Ludovic H., our frequent correspondent and faithful listener. And Ludovic says, what do you think about investing in Russian real estate with proper management and so on? It is the most contrarian thing I can come up with. Most real estate does. It could generate income. I'm thinking about it. Need to put the inheritance to work on a smart method. Well, Ludovic, I'm not sure about Russian real estate. I have thought Russia to be uninvestable for some time. And that was confirmed by a guest we had on quite a while ago, in fact, named Bill Browder, who ran the biggest investment firm in Russia for some time until the government killed his lawyer and threw him out of the country and tried to seize his business. So I've thought that the country was uninvestable. It's just the government is too capricious, to say the least. And we've learned that in a big way, haven't we? And all governments are capricious, right? They can all just suddenly decide to do something that affects a whole lot of people really badly. So if you invest in Russian real estate, you're on your own, buddy. I can't help you. Next is Ken C. And Ken C says, reading Buffett's shareholder letters, he and Mr. Munger, the two people who run Berkshire Hathaway, Warren Buffett and Charlie Munger, okay? He and Mr. Munger are big on Berkshire not paying any sort of dividend. One year, 2012, he said, shareholders by a large margin supported this. I can understand why on Mr. Buffett's side of the table, but my side has a question, to wit, before I can profit for retiring, I must sell one or more shares of stock. To me, this is like selling a business to profit when all I want is the steady income, dividend. This is analogous to Buffett having to encourage the selling of Geico for Buffett's old age. I'm not sure what you mean by that, Ken. I get why he likes Berkshire to retain dividends, etc., but not for individual investors who could use some dividends in old age. Thank you, Ken C. Ken, think of it this way. Either way, you are taking money out of the business, right? As you say, from your side of the table, meaning you're a shareholder and you want to take money out of the business in such a way to provide you with income in your old age. He's not going to pay a dividend. Just get that idea out of your head. It's not going to happen. And I doubt if anybody who comes after him will pay a dividend either. Yeah. Just think of it, and Buffett has said that. He said, if you need the income, you just sell a small portion of stock every year. And if you have A shares, you can get them divided into B shares so you can, sell smaller increments. But that's the thing to do. That's the only way to handle this. If you have Berkshire and you want income from it, you're going to have to sell a little bit on a regular basis to simulate an income. And either way, as a shareholder, you're taking money out of the business either way. Next is David P. And David wrote a rather long email to say that he heard someone say that stocks have outperformed gold over the long term. And I had recently said on the program that gold has in fact doubled the return of the S&P 500 this century, in the 21st century. So how could they say that? Well, David, they can say it easily. It's true over a longer period of time than that. It's true over the very long term, over decades and several decades, 100 years, something like that. But I want to reiterate something. If you recall, every time I talk about gold outperforming stocks, I try to add that, but that's not the point. That's not the point of holding gold. Gold is not a substitute for investing in a business that generates excess cash flows. They're two completely different things. Gold is a form of savings that gets your money outside of the currency and keeps it there for as long as you hold your gold. They're two completely different propositions. I don't care how gold seems to perform relative to stocks. I know over the long term, it's going to protect me from the natural degradation of all fiat currencies. But I'm glad you asked. Next is Steve M. And Steve M says, suppose one were to employ second-order thinking to understand the rationale for the invasion of Ukraine, which seems much more brutal than would be the case if the objective was to gain control of territory. Suppose one were to employ second-order thinking to understand the rationale for the invasion of Ukraine, which seems much more brutal than would be the case if the objective was to gain control of the territory. Suppose Russia fully expected the West to employ the most draconian economic sanctions imaginable. What if one were to consider the invasion as a catalyst to accelerate the decline of the US dollar as the medium of international trade settlement? Beyond holding precious metals, commodities, and companies that generate dollars faster than inflation, what more can an investor concerned about such issues do? Thanks, Steve M. Steve, as far as what to do, I covered it. And I mean, you got it. Precious metals, commodities, companies that generate dollars faster than inflation, little Bitcoin, boom, maybe a little real estate, you're done. And some people are into collectibles too, and they can do other things that I'm personally not comfortable doing because I don't do them. I mentioned a guy one time who invests in whiskey stored in casks in Scotland, and you better believe there's always going to be a demand for that, right? So the price will go up during inflation. But your idea that the invasion of Ukraine is too brutal if the case was to gain control of the territory, I agree. It's just, I mean, if Western media is to be trusted in their reporting of this, it's brutal. They're executing civilians. They're finding bodies with people's hands tied behind their backs. And, they show pictures of the devastation. It looks just absolutely, they've just laid waste to cities. And, it's not habitable anymore. You can't live there. So I don't know what they're doing. I suppose that could be the case. They could have had some idea that they would affect the US dollar as the reserve currency. We know the history of this just in broad strokes. We know that the history is that every century or so, the reserve currency changes hands, and it's been, a little over a century. So since the world reserve currency changed from the British pound to the US dollar. So it makes sense what you're saying. And like I said, as for what to do about it, I think you've got it covered. And let's finish on a happy note this week with John A. John A says, Dan, just wanted to congratulate you on a superb episode taking a bullish stance on human progress on March 28th with Kevin Duffy. It was one of the most thought-provoking and unbridled discussions I've heard in a long time. Long live free speech. Please keep bringing Mr. Duffy back. He is great, and he brings out the best in you as well. His statement, "It's held together by stimulus checks, nuclear threats, and gender pronouns," was simply awesome. Ending the episode on a positive note was much appreciated also, especially by old worrywarts like me. Keep them coming, Dan. Your loyal listener and subscriber, John A. Thank you very much, John. And just for the other listeners, that I think that was Kevin's idea about what the US dollar is held together with: stimulus checks, nuclear threats, and gender pronouns. I think that's what it was. But yeah, I agree. Kevin and I always enjoy interacting with each other. And you can bet your bottom dollar, John, he will be back. He'll be back. We'll have him back at least once a year if I have anything to say about it. So thank you, John. And thank you all. That's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might enjoy it also, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop me a note, feedback@investorhour.com. Or call the listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.